Equitas Small Finance Bank in the spotlight. P.N. Vasudevan is the Managing Director and CEO, now joining in to discuss the quarter gone by. Thank you so much for taking time out. And it was a bit of a muted quarter. The MFI credit costs have risen to the FY22 level. So what is impacting your book? Is it coming from a specific segment or a specific geography?
To address the asset quality issue upfront, we have 16% of our advances is contributed by microfinance. The remaining 84% is contributed by other products, which are all secured, except microfinance, everything else is secured. And if you see the credit cost of the rest of the book, which is at 84% of the book, the credit cost for the first half of the year is 1.03%, which is quite in line with our normal, situation. So it's quite normal. And so we don't have any credit quality issue as far as the remaining 84% of the book is concerned. As far as that microfinance is concerned, the 16% of the book, yes. So we have obviously, like everybody else, we are also seeing some level of stress in that book. And, the credit cost for the first half of the year is actually 10% on that. Of course, the 10% includes the 145 crores of extra provision that we made in the second quarter for microfinance, because we are obviously seeing the stress and we wanted to do some proactive, provisioning against what we are likely to see the further stress in third and fourth quarter. So we took a 145 crore additional provision hit in the second quarter. Including that, the credit cost comes to about 10% on the microfinance book. So if you see 10% of 16% of the book, which is 1.6%, and the remaining 84% at 1.04%, if you total these two, then the overall bank credit cost comes to about 2.5, 2.6%. So that's a scenario that we are currently in. And microfinance is something obviously the entire industry and we are all jointly working towards.
Right. And what about the collection efficiency? Because that's around 98% right now. Should we expect higher NPAs and credit costs in the coming quarters?
As I've been saying, the stress in microfinance is real. And for the first time in the last 18 years that we have been in this industry, we are seeing the microfinance stress arising from factors which are internal to the industry and not external. So far, it's always been an external factor. And the second thing is that this time we see it more widespread compared to the past, where it always used to be geographic specific. So that is why we see a larger stress across the industry on microfinance. In terms of how much we see our own portfolio behaving and what likely credit costs coming up in the next 2-3 quarters, as I mentioned, October did show us some little bit of a green shoot, in the sense that the deterioration was not more than the September. And that is the kind of green shoot that we saw in October. And as I mentioned, we have put in a few initiatives on the ground, including, adding more people on the field, helping them to spend longer time with the clients. And so basically, we are trying to understand from the clients what is the real problem, why are they not paying? And, if they are really having a genuine financial trouble, either because their income has gone down or because they have really over borrowed and they are not able to pay. Actually, we are a bank. Unlike, we are not an NBFC, we are a bank. So we do have a range of products and services that we can offer to such customers to help them come out of their trouble and get back to normalcy. So that is the kind of schemes and plans that have been rolled out to the branch. And over time, we hope that some of them will help the clients come back, and in the process, of course, help the bank also. So from a specific guidance, we are not really in a position to guide you just now in terms of what likely credit costs we may be able to see in microfinance in the next 2 quarters. But by and large, I believe that the 100 crore, the buffer that we have created, should significantly help, kind of cushion the potential credit costs that we will see coming up.
Okay, fair enough. But given the pressure that you're talking about in the MFI segment, do you think this 25% growth that you had earlier talked about is still achievable? Because this quarter we saw 15% growth. What's the overall expectation for the entire year?
As a bank, on a normal basis, we should be able to look at a growth of anywhere around 25% on an ongoing basis. Current year, I think that's not going to be possible. And, we have a 15% growth for the first half, which includes a 20% growth in the rest of the bank and a degrowth in microfinance, resulting in an overall 15% growth. The third and fourth quarter generally are the best for all banks, including us. They are generally the best both in terms of disbursement and in terms of collections. So we do expect a higher level of growth in the second half coming up. So from a 15% first half growth, whether we will be able to reach the 25, I doubt that we will be able to reach 25 for this year. Clearly, this year 25 is not going to be possible. But we are not right now guiding for the growth for the current year. It is going to be definitely better than the first year because normally the second half is always better. But on an ongoing basis, if you look at a medium to long term basis, I think over the next 2, 3, 4 years, we should be able to look at a 25% growth.
Right, and the cost of funds is also rising. So what do you think that the outlook is in terms of your cost of funds? Have they peaked? Will we see a flat trend now from here on?
In terms of cost of funds, if you see that our cost of funds has kind of stabilized around that 7.3 to 7.4 to 7.5% level. So our interest cost has definitely peaked, and most of the old deposits have come up for maturity and renewals. And so the question is that how much of that will be the additional cost going forward. We have done two things on the interest rates. On savings account, we tweaked our slabs in the first quarter. Once again, we tweaked it in the month of October. Both of them helping us to reduce the cost of savings account deposits by about 14 basis points during the year. Second thing that we did is in the month of October, we have reduced our peak interest rate on TD from 8.5 to 8.25. So today the highest rate we pay on TD is 8.25 compared to 8.5 we are paying till September. Now, as deposits mature and get renewed at this rate, obviously there will be some benefit on the interest cost to the bank. But clearly, I think we have peaked out. 7.5 is clearly the peak out, and I don't think the cost of funds is going to increase beyond that unless something else changes and dramatically happens in the industry. On a given current scenario basis, we have peaked on the interest rates, and we might see a marginal reduction because we have taken some effort in reducing our interest rate on deposits.
Okay, and in the event of a rate cut, how do you see the net interest margins moving and how much of the loan book is linked to fixed rates?
In case of a rate cut, we'll actually stand to benefit because almost 83-84% of our book is fixed rate loans. And so we have actually had the reverse of the benefit. We had a negative impact because of the interest rates going up over the last 1.5, 2 years. And so if and when the interest rates actually start going down, we should see a benefit coming to the bank because 83-84% of our book on lending is actually fixed, right? And so that will actually benefit them.
Right, and given that you're moving towards application for universal banking, last quarter you had made provisions to recalibrate NPAs within the guided range. But with rising stress, do you think the bank is still on track? Will the NNPAs remain below that 1% mark?
Yeah, absolutely. So that's a track on which we are proceeding. So subject to everything being normal, definitely we will aim to keep our NNPA less than 1%. And we'll aim to be eligible for applying for universal bank at the end of FY26. That's March 26.
Okay, on that note, we'll let you go. Thanks so much for making time and speaking with us today. Equitas Small Finance Bank a little lower in the trading session, and clearly the management sense that it will be difficult to reach that guidance of 25% given the pressure in the MFI book.